So let's get started with As7 Construction Contracts. Okay, this standard is predominantly, I would say, theory oriented, but yes, you do get some practical questions from this standard. Okay, so let us understand the standard and its gist first and then approach the questions. Friends, what is As7? It is going to speak about construction, contracts for construction, and the purpose is to account for these contracts not from the books of the person for whom the construction is made. It is from the books of the person who is making the construction. Okay, so basically the person who undertakes the construction contract and how accounting has to be made in his books. Okay, that is all As7 is all about. In group 1, you would have learnt about contract costing. So contract costing is basically derived from As7. So what you have learnt as practical questions under contract costing is based out of principles of As7. Right? So construction contract is a contract specifically negotiated for construction of an asset or a combination of assets. These contracts are generally undertaken over more than one accounting period. So the purpose is accounting where the contracts are going to span over more than one accounting period. First thing, we are going to speak about recognition. So what is the recognition rule? As per As7, if multiple construction contracts are undertaken from the customer, then two rules. It shall be taken either as separate contract, which means each particular contract, multiple contract is separate, or it can be taken as a group contract or one single contract. Now, how do we identify the two rules? Okay. First condition. If you are going to submit separate proposals, which means I am going to give separate negotiation proposals, offers for separate contracts. Whether it is a single customer, whether it is multiple customers, doesn't matter. Okay, point number 1. Point number 2, you can negotiate for each of the contract independently, and the customer can reject one, accept another. So the option of rejecting one independent offer or accepting one independent offer is there for the customer without affecting the other contracts. Third, you can identify the cost incurred for that particular contract individually. For each particular contract individually, the cost and revenues can be identified. So 3 rules: separate negotiations or separate proposals. Second, you should have separate negotiating capacity, and the customer should have the option to accept or reject independently. Third, cost and revenue should be independently identifiable. If these 3 are present, then it shall be treated as separate contract. Each contract shall be treated as a separate contract. Suppose if this is not present, then what is the rule? It shall be treated as a single contract. Okay. Now you can ask, is this 3 conditions mandatory, or even if one of the 3 conditions is satisfied, I can go ahead? Is all the 3 conditions are mandatory? Yes. All 3 conditions should be satisfied for identification of separate contracts. Even if one of the condition is not satisfied, then it will go for group contract or a single contract. So in the absence of any of the above conditions, even if one of the condition is not satisfied, then the group of the contract shall be recognized as a single contract, even if it is from multiple customers. Even if it is given from multiple customers. So this is the first rule of recognition, whether the contracts have to be recognized separately or as a single contract. Second, measurement. So first we have completed recognition, next we come to the measurement. So when it comes to contract, yes Radha, all the 3 conditions are mandatory for separate contracts. Right. So when it comes to measurement, we are going to discuss about two parts, revenue, cost. So what is cost? Any costs that are directly attributable to the construction, and any cost which can be allocated to the construction. Say for example, if you are incurring common electricity, or you are using one common machinery, say one common JCB for construction for across 5 projects, can I allocate that as construction cost? Yes, you can allocate it as construction cost, provided it is agreed under the terms of the agreement. Okay, so either it should be directly related to the construction, or as per the agreement, if you are allowing for allocation of cost, then that can be considered. Same is the rule for revenue. You should have directly attributable revenues, which means cost of the project or revenue from the project. Or if there is any other revenue like escalation clause, if I am going to get additional amount in case of a change in prices in the future, you should have agreed it in prior. Only then it will be treated as a part of contract revenue. So what is construction contract cost and revenue? Those that are directly attributable to the contract and chargeable as per the terms of the contract. So two parts, either directly attributable or chargeable as per the terms. Now coming to types of construction contract. So primarily there are two types of construction contracts. What are the two types of construction contracts? Fixed price contract and cost plus contract. What is a fixed price contract? The price of the contract, which means the value that you are going to arrive from that contract or get as revenue from that contract, is fixed. Either as a lump sum or as a flat rate per unit. Like all construction contracts today, buildings and all, they will say 2000 per BHK, 1500 per BHK, per square feet, not BHK, 1500 per square feet. So each square feet, they are assigning a rate. So that is also a fixed price contract. Or if there is a lump sum agreement saying that for this contract, the value is 30 lakhs. So they will come under the category of fixed price contract. One question that has been asked theoretically in one of your papers is, what are the rules to recognize a fixed price contract? Again, 3 rules. First, I should be able to measure the cost reliably. So the cost contract price is measurable reliably. Second, there is certainty of receiving the income, which means it is probable that future economic benefits will flow to the enterprise. There is a certainty of receiving the income. So 2 points. These are very common points, reliable measurement and probable of future economic benefits. Third, construction costs incurred till date and estimated cost of completion and the stage of completion. 3 points. Cost incurred till date, costs required for the future, stage of completion are identifiable as on the reporting date. Suppose a contract has started on 1st January. As on 31st March, you want to know whether it is a fixed price contract or cost plus. So first rule, cost price you should know. Construction contract price you should know. Second, you should be certain that the benefits will flow to the enterprise. Third, cost incurred for the period should be known. What is the future cost that will be probable should be known. Third, you should know the stage of completion. If all of this you are able to identify, then you can categorize this as a fixed price contract. Okay. Second, cost plus contract. What is a cost plus contract? Yes, ma'am. Reporting date is the date on which you are either finalizing your books of accounts or showing your books of accounts to other. It can be any date on which you are reviewing your books. Generally, reporting dates are usually considered as financial year closures, because that is the period of reporting that we are concerned about. Next, cost plus contract. What is a cost plus? The word itself says it is a value beyond cost. The price of the contract is based on cost, which is reimbursement of the cost, plus a fixed fees above the cost. Say they can say cost plus 10,000 rupees or cost plus 10% of the total cost. So it will either be a fixed cost plus percentage or fixed cost plus fixed revenue. So any of this is called as a cost plus contract, where the definition is based on cost and not a fixed sum in advance. Okay. Now in cost plus contract, the rule is very clear. You cannot identify very clearly the cost incurred. That is why you are entering into a cost price contract. If you are able to predict the prices, you will go for a fixed price contract. You are going for a cost plus contract because you are not clearly able to identify the cost or measure the cost. You can identify, but sometimes you may not be able to measure the cost. The prices can be fluctuating or volatile, right? So for a cost plus contract, the rule is only two. It is probable that the benefits will flow to the enterprise. Costs incurred till date can be identified. You cannot estimate future costs. I cannot estimate the total cost. So I can only estimate or find out whatever is the actual cost incurred till date. So for a cost plus contract, only two rules: future economic benefits and second, cost incurred till date shall be identifiable. So clear distinction. Remember, for a fixed price contract, estimate should also be available. Whereas for a cost plus contract, that is not required. Okay. Make a note of these 2 points. Right? Next. Okay, so this is about classification of contract. Now, for recognizing the contract in the books, there are certain rules that we are going to remember. Okay? 3 rules. I would simply put it as 3 rules. First rule is percentage completion. Second rule is cost completion. Or third rule is total cost evaluation. Okay, totally 3 rules. Remember these 3 rules, your construction costing will be easier. Rule number 1, percentage completion. I will go in a different order, then I will come to whatever is given in the statement. Percentage completion. The revenue shall be recognized based on percentage completed or work certified. Suppose if your total contract is 100 crores, I have completed till the reporting date 40% of the work. What is the revenue to be recognized? 100 crores into 40%, which is 40 crores revenue. And whatever is incurred for that 40 crores revenue, whatever cost you have incurred till date shall be taken to contract cost. So in the revenue, you will have 40 crores. In the cost, we will have actual cost. The difference will be profit or loss for the year. Right? This is first rule. Second, I don't know percentage completion. In fixed price contract, you can identify percentage completion. Suppose you don't know percentage completion. Go to the second rule. Okay. Do you have actual cost incurred? Yes. Do you have total estimated cost? Yes. So, contract revenue is recognized as a proportion of cost incurred divided by total cost. So, let's write the formula for each thing. For percentage completion, the formula is contract revenue is equal to total revenue into percentage completed or work certified or percentage work certified, whichever is available in the question. If that is not available, contract revenue for the period is equal to total revenue into actual cost incurred till date divided by total estimated cost divided by total estimated cost. So rule number 1, percentage irka. Not available, go to rule number 2. Two rules, is it clear? Okay. Now coming to the third rule, and this will summarize your entire contract costing. What is the third rule? The third rule is check total revenue and total cost. Total revenue, total estimated cost. Suppose if the total cost is exceeding the total revenue, which means total estimated cost of the contract is say 120 crores. Total revenue is only 100 crores. Then the entire 20 crores will be immediately recognized as loss. Ivladhan, 3 rules of a construction contract. Remember this, you can do any question. Okay? If the contract cost exceeds the contract revenue, the expected loss shall be immediately recognized in the books in the same first year itself. Right? So these are the 3 points under construction contracts for recognition each year. Please make a note. Right? Okay. Now, what if there is a change in the estimated revenue or estimated cost? If suppose the revenue is revised or if the cost estimate is revised, will the contract revenue and cost change for the period? Yes. If the estimated revenue and estimated cost is revised, then accordingly your contract cost and revenue will be revised for the year also. How it will be revised? In the total estimated cost, revised value will be taken. In the total revenue also, revised value will be taken. Your formula, total revenue also revised value will be taken. Total estimated cost also revised value will be taken. Simple rule. So only 3 rules for us to remember here. Percentage completion, else actual cost to total estimated cost, or if total cost exceeds total revenue, entire value to be taken as expected loss. Okay. So these are the 3 basic points of the standard. In case of any subsequent revision in the estimation of cost or revenue, such estimation shall be considered for calculation of amount to be recognized in P&L account. So in that case, in case of revision of estimate, total revenue or total estimated cost will be revised. Whichever is applicable will be revised. Right? So As7 questioning areas, if you see, first area of question, whether a contract shall be treated as a single contract or separate contracts. First area. Second, whether it is a fixed price contract or a cost plus contract. Third, calculation of cost or revenue, calculation of contract cost and revenue for the contracts. And one separate question generally is asked, or where sometimes separate question is asked, where the contract cost will exceed the contract revenue and we need to take the entire loss. So these are the 4 types of questions that are getting occurring repeatedly in your AS7. Run through the standard for 2 minutes and then we start with the practical questions. Any doubts? You can ask now. Friends online, I hope the standard is clear.
Single contract, separate contract.
Because generally when construction companies or when construction businesses are taking multiple contracts, if you account it as a single contract or multiple contracts, your profiting will change accordingly based on allocations of cost, etc. So to ensure that there is a uniform practice followed, this concept of single and separate contracts was brought in.
Style of accounting also. Fixed price நீங்க காஸ்ட் சொன்னீங்கன்னா அதுக்குள்ள முடிச்சிடுவீங்க. The house 50 lakhs.
No, even in fixed price contracts, we need not complete it in the same fixed price. We can have extension of price also. We can say if the prices are increasing, you will get a claim, you will get a variation claim or escalation claim like that. But the idea is when you start the contract, you know your expected revenue. Right? So we start with the questions. Question number 5A. B Limited undertook a construction contract for 50 crores in April 2020. The cost of construction was initially estimated at 35 crores. The contract is to be completed in 3 years. While executing the contract, the company estimated that the cost of completion of the contract would be 53 crores. Okay? Can the company provide for the expected loss in the financial statements for the year ended 31st March 2021? Okay? So here, for calculation of loss or profit, we only have 3 rules. Either percentage completion, here we don't have percentage completion. Do we have actual costs? We only have estimated cost. So 2 rules over. What is the third rule? Total cost, total revenue, ma'am. Let's check the answer. 50 crores is the construction revenue. Initial estimate is 35 crores. However, the estimated cost of completion was 53 crores. So what is the total estimated cost? Is it 53 plus 35 or is it 53 only? It is 53 only. Remember, you cannot take the summation of 2 estimates. You can only add actual plus estimate. Actual till date plus estimate for the future. ரெண்டு estimate direct add பண்ண முடியாது. Estimate is subject to change. Okay? So, initially estimated as 35 crores is not relevant for us. What is relevant here? The cost of completion is 53 crores. So, total estimated cost is 53 crores. Suppose, friends, here I am hinting you, if the question says, while executing the contract, the company estimated that the further cost of completion, if the word further cost is available, then add the both estimations. If the word further is not available, then we will only take the total estimation given. Make a note of the hint somewhere in your material. Yes. Okay, if the word further is given, then accordingly you need to sum. Okay. Now, can the company provide for the expected loss? Total cost, estimated cost exceeds the total revenue. Therefore, the expected loss has to be recognized in the same financial year immediately. Yes? So let's check the answer. As per AS7, when it is probable that the total contract cost exceeds the contract revenue, the expected loss should be recognized as an expense immediately. Therefore, the foreseeable loss of 3 crores, okay, should be recognized immediately in the financial year, irrespective of whether the work has commenced or not, stage of completion, or the amount of profits expected to arise in the future. So whether work has started or not, we are not bothered. Whether what is the stage of completion, 5%, 10%, 20%, we are not bothered. Whether in the future it will result in profits, we are not bothered. So irrespective of the 3 crores loss needs to be recognized in the books. Make note of the hints from the question. The solutions PDF will also be available to you, but for your reference, I would suggest make relevant hints so that it helps you in your examination preparation. Shall we continue? Yes, Vishwa, you will get the revised material PDF also. Don't worry. Right. Question 5B. Silence, please. Rajendra undertook a contract of 20 lakhs on arrangement that 80% of the value of work done as certified by the architect of the contractee should be paid immediately, and 20% will be retained until the contract is completed, which means whatever is the work certified, so 80% of the value immediate payment, 20% will be retained and paid later. Year 1, the amounts expected was 8,60,000, work certified 8 lakhs. 80% of this was paid as agreed. So 80% of 8 lakhs is 6.4 lakhs. It was estimated that future expenditure, so here it is further expenditure or future expenditure to complete the contract will be 10 lakhs. Year 2, the amount expended was 4,75,000. 3/4 of the work under the contract was certified as done by 31st December and 80% was received. It was estimated that the future expenditure will be 4 lakhs, further 4 lakhs. In year 3, amount spent was 3,10,000. On 30th June, the whole contract was completed. Show how the contract revenue will be recognized in P&L for the 3 years. So we are going to calculate the contract revenue for the 3 years. Okay. So here at every stage, we will be calculating the revenue to be taken to P&L. But at every stage, you should also check whether total cost exceeds total revenue. This rule you should always keep in mind and check irrespective of whether you are doing percentage completion or cost divided by total estimated cost. Edu pannalume, you need to check this particular rule. Okay. So let's go to the answer. Let's first see in year 1. The amount anticipated was 8,60,000. Amount expended was 8,60,000. Spent is 8,60,000. Work certified of 8 lakhs, of which 80% is received. Future expenditure is 10 lakhs. So what is the total cost? 8,60,000 plus 10 lakhs, which is 18,60,000. Is it exceeding 20 lakhs? No. So need not recognize the total loss. Safe. So now let us go to the answer for year 1. Actual expenditure 8,60,000. Future estimated expenditure 10 lakhs. And therefore total expenses 18,60,000. Okay, I will give you time to take down. You can first listen and then we will take it down. Percentage of work completed is 8,60,000 divided by 18,60,000 into 100. Ma'am, why we are not doing percentage completion method? Let's see the question. The work certified was for 8 lakhs. Okay, and of which 80% was paid. Okay. So they have not given us percentage completion. The percentage of completion has not been given to us. We need to calculate that percentage completion. So if you do not have percentage completion, 40% of the work was completed. Like in the second year, they have told 3/4 of the work was certified. Some indication. So where we do not have enough information, we can go by the formula cost divided by total expected cost. I will come to it. Let me complete the year 1 calculation, then I will explain why you need to change the rule. Work was completed. Here percentage is 8,60,000 divided by 18,60,000 into 100, which is 46.24%. So the revenue to be recognized is 20 lakhs into 46.24%, which is 9,24,800. Here, now you can ask, ma'am, why should I not recognize 8 lakh work certified? Why I should not recognize as 8 lakh? Now let's see the question. 8 lakh is the work completed or work certified, but what is the actual cost spent? 8,60,000, which is higher. So the rule is, if work certified is lesser than the actual cost, go by actual cost. Okay, if work certified is more, then we can go by work certified. So let's write that rule also in the notes. Okay, if work certified is less than actual cost incurred, then actual cost divided by total estimated cost shall be considered. See, the reason is very simple. It is a matching concept. You have spent for 8,60,000, so proportionate revenue we need to recognize. That is why we are going by this rule. If work certified is less, then go by the extent of actual cost incurred. So your answer for year 1 will be 9,24,800. Please make a note. You can take down for year 1. Any doubts for year 1? Yes. Wait. Allow me to complete. Yes, ma'am. 20 lakhs is the total revenue or contract price, whichever is the. Because work certified is less than the contract cost or actual cost incurred. Work certified is only 8 lakhs. Cost incurred is 8,60,000. So the standard says if your cost incurred for the year is more than the work certified, you should go only by cost incurred. You cannot go by work certified. The principle is matching concept. You have spent for 8,60,000. So you have to recognize revenue for 8,60,000. Yeah. Okay, this was your RTP question again. Latest RTP question. Take down for year 1, then we will go for year 2. Shall we go to year 2? Now year 2, listen very carefully. Actual expense. Is the question? Okay. Actual expense in year 2 was 4,75,000. Year 1 we have already spent 8,60,000. Year 2 4,75,000. So expenditure in year 1 8,60,000. Actual expenditure in year 2 4,75,000. Or you can combine both and write saying 8,60,000 plus 4,75,000. Next part of the question, estimated future expenditure will be 4 lakhs. So future expenditure is 4 lakhs, giving you a total expense of 17,35,000. Is it still less than the contract price? Yes. So therefore, we will still go ahead and do the percentage completion. Now, okay, what is the percentage of work completed? 4,75,000 plus 8,60,000. What is the total cost? Total actual cost? 18 lakh or 13,35,000. Okay, let me write a hint here. Total actual cost is 13,35,000. Okay. The question also says 3/4 of the work under the contract was certified. So let us do work certified, which is 3/4 of 20 lakhs, which amounts to 3/4 of 20 lakhs.
15 lakhs.
15 lakhs. Okay. Right? So far clear? Okay. So percentage of work certified is approximately 15 lakhs, but you have incurred for 13,35,000. We are not stopping here. Immediately, let's not conclude. Calculate percentage of work completed based on the cost formula. 4,75,000 plus 8,60,000, which is 13,35,000 divided by 17,35,000. What is the value? 76.95 percentage. Is it more than 3/4 or less than 3/4? More than 3/4. As a value, if you see, it is less. But as a proportion to the total cost, it is more. In that case also, we will only go by actual cost of recognition. Okay, two rules here. First, see the value of actual cost. Actual cost more than work certified na kanna mudita actual cost basis only. Second rule, actual cost is less, but percentage of work certified is more. Sorry, percentage of actual cost incurred is more than work certified. Then again, what we are going to do, we are only going to go by the percentage of actual cost, which is 76.95 percentage. So let me write the rule here. Since percentage of actual cost to total estimated cost is greater than percentage of work certified, the percentage of actual cost shall be used. Okay. So here basically which formula we are following? We are not following percentage completion method. We are following actual cost to estimated cost method. Now, for the answer, listen carefully. You can take down separately. Revenue to be recognized. Total revenue to be recognized is 20 lakhs into 76.95 percentage, which is 15 lakhs 39,000. Total revenue is 15 lakh 39,000. Less revenue recognized in year 1. What is the revenue recognized already in year 1? We have already recognized for 9,24,800. Therefore, the incremental portion alone will come for year 2, which is 6,14,200. Take down in a manner that you will understand along with the relevant hints. Take down. Yeah, I will go. Any doubts, friends online? Any doubts in understanding year 2 calculation?
17 lakh 35 greater than 15 lakhs, so they are taking actual.
Yes. Yes, ma'am. Can you repeat second year calculation? Okay, I am repeating second year calculation. First, I am going to calculate total actual cost. What is total actual cost? 4,75,000 plus 8,60,000, which is 13,35,000. Silence, please. 13,35,000. Next, work certified is 3/4 of the total cost, which total project, which is 15 lakhs. Now, I am going to check whether the percentage of work certified is more than 3/4 or not. Sorry, is percentage of actual cost is more than 3/4 or not. So, percentage of work completed is 13,35,000 divided by total estimated cost 17,35,000, which is 76.95% greater than the work certified. Therefore, we go by actual cost for recognition. So, how do we calculate for actual cost recognition? We are going to take 20 lakhs total revenue. Till year 2, how much is the cost completed? 76.95%. So 20 lakhs into 76.95% will give you 15,39,000. 15,39,000 is the revenue for 2 years, year 1 and year 2, of which we have already recognized the revenue for year 1, which is 9,24,800. Therefore, the revenue for year 2 is going to be 6,14,200. Right? And one more small hint for your exam. Mostly, friends, the questions that are asked are based on actual cost divided by total estimated cost only. Okay. If the percentage of work completed, don't go by work certified also, percentage of work completed. If that percentage is given in the question, go by percentage completion method. Adi illana, kanna mudittu we can do this formula. Actual cost divided by total estimated cost. 99.9% all your sums are going to be like this only. Okay, so this formula you can use in all the questions for calculation directly. Now year 3, let's go ahead and complete year 3. The amount expended was 3,10,000. So first year 8,60,000, second year 4,75,000, third year 3,10,000. Full contract was completed. So idhila no question of percentage completion at all. Full contract is over. So let's calculate the actual cost. What is the actual cost? 8,60,000 plus 4,75,000 plus 3,10,000. What is the total cost? 16,45,000. Is it still less than 20 lakhs? Yes. So that rule we will always check. Second, now we are going to recognize the contract revenue. What is the total revenue? The total revenue is 20 lakhs, of which year 1 we have recognized 9,24,800. Year 2 we have recognized 6,14,200. So subtract, we get 4,61,000 to be recognized for year 3. In year 3, since the entire contract is completed, there is no question of percentage completion. We are taking the full 20 lakhs as the basis. But remember, every place you need to check cost exceeding revenue or not. Adu check pannama answer pottingna, you will somewhere, if they have given a small twist in the question, we will end up missing it. Okay, so everywhere please check cost should be less than the revenue. Only then you can go ahead and do this working. Take down the answers. Yes, Sanjay. Your logic is correct. Yeah. Question number 6. Uday Constructions undertake to construct a bridge for Government of Uttar Pradesh. The construction commenced during the financial year ending 31/3/19 and is likely to be completed by the next financial year. The contract is for a fixed price of 12 crores with an escalation clause. So with a revision here. You are given the following information for the year ended 31/3/19. Cost incurred up to 31/3, 4 crores. Further cost estimated to complete the contract, 6 crores. Escalation in cost was by 5%. Hence, the contract price is also increased by 5%. You are required to ascertain the stage of completion and compute the revenue and profit to be recognized. So, revenue is only income and profit to be recognized. So, when I say profit, you have to do revenue minus cost for the year as per AS7. Okay. So, here, first thing, up to 31/3, we have the actual cost. We have further cost. Do we have percentage completion given? No. So what formula are we going to use? Actual cost divided by total cost into contract revenue. Okay. But here we should remember that there is a price escalation. Right. So the price escalation should be considered for revenue as well as cost. For revenue as well as cost. 2 minutes time, try the answer. Work out the answer and then we will discuss. We can do it independently. Independently, please. Okay. So let's check the answer. Cost of construction 4 crores. Estimated future cost 6 crores. Okay. Is the question giving the estimated future cost after escalation or before escalation? That is the key. So reading the question, the contract, the I'm reading the question again here. The contract is for a fixed price of 12 crores with an escalation clause. Cost incurred up to 31.3 is 4 crores. Further cost estimated to complete the contract 6 crores. Escalation in cost was by 5%, which means they have already included the 5% in 6 crores. ஒரே ஒரு word தான் will change your entire answer. So, read the question in between the lines. Okay? So, they have already included the estimated cost inside. Ma'am, if it is excluded, how it will be given? It is estimated that the cost will be escalated by 6 crores or sorry by 5% or escalation is 5% or 6%. Then you have to add it separately. Okay? Now listen here. The second part of the statement, hence the contract price is increased by 5%, which means you need to increase the contract price by 5%. Okay, so here the hint is in cost escalation is already made, whereas in contract price escalation you need to make the escalation. Okay, so for removal of confusion you can also write a note saying it is assumed that future estimated cost is after consideration of escalation. Okay, is after consideration of escalation. So cost of construction 4 crores. Estimated future cost 6 crores after escalation. So 6 crores. Total estimated cost 10 crores. Contract price 12 crores into 105%, which is 12.6 crores. Now, stage of completion, we need not do this formula also. We can directly compute 12.6 crores into 4 by 10. 12.6 crores into 4 by 10, which will give you the answer of 5.04 crores as the contract revenue. Contract profit is equal to, for the year ended 31st March is equal to revenue 5.04 crores minus actual cost 4 crores. 5.04 minus 4, which is 1.04 crores. Yes. Okay, 1.04 crores. So this is your answer for question number 6. Very small hint. Okay, we might have practiced with cost escalation probably in the class if you have practiced in the class generally. But see the question whether the word given has already been escalated or is to be escalated, and accordingly decide the answer. Right? So this is your question number 6. Any doubts? Friends online or here, friends here, anyone, any doubts in this? Okay. You've taken down, right? Can we continue? Yeah. So this summarizes As7 construction contracts. So points to remember, always check whether contract revenue is exceeding contract cost. If contract cost is exceeding, expected loss will come. Then if percentage completion is openly not given, kanna mudi to apply the formula actual cost divided by total cost. Okay. Third, if escalation clause is given, check whether escalation is included or not. If it's not included, include the escalation while calculation. Okay. So 3 major points. This will help you through As7. Right? Moving on to the next standard, As9 Revenue Recognition. Okay. Again, this is a mandatory standard. This standard is applicable universally for all enterprises or all companies. Okay. Now, what is revenue recognition speaking? It is going to say how and when revenue has to be recognized in case of entities. So, revenue is broadly categorized into three forms. Any revenue from sale of services, from sale of goods. Second, any revenue from services. Okay. And third, any other revenue like interest, commission, royalty, dividends, whatever it is. So, sale of goods is one area to discuss. Rendering of services is another aspect. Third, all other forms of revenue. Okay. Broadly, all revenues will get covered under this. Suppose if there is a separate standard like construction contracts, like lease. So wherever there is a separate standard, that specific standard will govern. This is a generic standard. Okay. So first rule for sale of goods. Revenue from sale of goods shall be recognized. 3 points. When the seller has transferred the property in the goods to the buyer for consideration. So the property in the goods has to be transferred. When I say property, it is not necessarily ownership. Okay, property here is not only ownership, not only possession, it is a combination. And here we will always go by substance over form. Legal ownership is not the only mandatory point. You should have the risk and rewards being transferred, which is your second point. All significant risk and rewards of ownership has been transferred to the buyer. Third, there is no uncertainty in the amount of consideration received. There is no uncertainty in the amount of consideration received or receivable. So, 3 points here. Seller has transferred the goods to the buyer. All risk and rewards of ownership have been transferred. Third, there is no uncertainty in the amount of consideration. So, if there is uncertainty, which means you have done your transfer, the risk and rewards have been transferred, but you do not anticipate the money to be collected. Then in that case, should I recognize the revenue? No. Revenue recognition should be done only when the money is actually collected. So if there is uncertainty, revenue recognition has to be postponed. So this is all the rule about AS9 for sale of goods. There is no other rule. Only 3 points for us to remember. Property transfer, risk and rewards transfer, certainty of collection. Right? Yes, sir. Risk and rewards here indicate any risk related to the ownership of the goods, like damage to the goods. Who will bear the damage to the goods? Any rewards from the goods, like if the goods are going to earn some income, who will take the income from it? So all this, if this transfer to the buyer, then it becomes a sale. Okay. Right. Second part of the standard, rendering of services. So what is rendering of services? Any activity done where there is a service yet to be rendered or completed. Now there are two types of services rendering. One, percentage completion or proportionate completion, where it is a continuing service or continuous service. Classic examples can be your mobile phone bills, where the service is on an ongoing basis. Okay, and whatever extent the service is completed, you are getting billed. So 1 month service provided, 1 month bill is raised, right? So in that case, revenue is recognized based on the degree of completion of service. So you take a cutoff date. On that date, whatever service is completed, that revenue will be recognized. Okay. Else, if it is a completed contract, like I am doing a specific service is over, then I will collect the revenue. So when the service is completed, the revenue can be recognized, which is completed service method. Revenue is recognized when the service is complete or substantially completed, where you get the right to receive the income. In simple terms, the right to receive is established. Again, the same rule. However, if there is an uncertainty of the ultimate collection, then the revenue recognition shall be postponed. So for service, simple. If it is a continuing service, proportionate completion. Till whatever it is completed, raise the revenue. If it is completed service, After the service is completed or substantially completed, you can raise the revenue. What is substantial? It will depend on the facts of the case. Okay, it will be dependent on what is the scenario and you can decide accordingly. Third, income from other sources. So for other sources, there are three categories: time based, agreement based, right to receive based. Okay, time based is interest, where interest is not always based on right to receive. Interest, suppose if you are going to deposit 10 rupees, interest is going to be receivable on the 10 rupees from day one, which means interest is an income that is receivable based on the time lapse at whatever is the fixed percentage. So, irrespective of whether the agreement is mentioning or not, it is silent or not, if the word is interest, if the nature of income is interest, then it has to be recorded on time proportion basis. Say for example, there is a agreement for commission receivable, and if suppose the commission is not paid on this particular date, interest will be recovered along with that commission. Commission is based on agreement, whereas interest will be based on time. Okay, so this is first thing, which is time based. Second, agreement based, royalty, commission, all these. Revenue is recognized on accrual basis in accordance with the terms of the agreement. So whatever is the agreement terms, accordingly you can recognize revenue. Once in 3 months, once in 6 months, however your agreement says, you can recognize the revenue. Third, right to receive. The only place where this will get established is dividend. Where dividends are not declared, there is no right to receive. Dividends can be receivable only when it is declared by the company. So here only when the declaration of dividend is made, not even proposal, declaration of dividend is made, only then dividend becomes receivable. So revenue is established or recognized when the right to receive the payment is established. So basically when dividend is declared. When dividend is declared. Again the same rule. However, if there is an uncertainty with respect to measurability or collectability, revenue recognition shall not be made. You will go actually whenever you are collecting it, you can recognize the revenue. Okay. So this is part 3, which is income from other sources or other forms of revenue. So only 3 forms, and this summarizes the standard. Very simple standard for us to remember. 3 rules: sale of goods, sale of services, and other income. Quickly run through and we'll start with the questions. Shall we? Question number 7. Question number 7. A. An infrastructure company has constructed a mall and entered into an agreement with tenants towards license fee, which is a monthly rental, and variable license fee as a percentage of turnover of the tenant on an annual basis. The chief financial officer of the company wants to account or recognize the license fee income for 12 months. Let it remain open. Wants to recognize license fee as income for 12 months during current year and variable license fee as income during next year, since invoice is raised in the subsequent year. Comment whether the treatment is correct or not. So he's saying 12 months income I will recognize for the current year for fixed fee. Variable fee income, next year only I am raising the invoice based on turnover. So next year only I will recognize it as revenue. Correct or not? So this is with respect to license fee. So which is a specified type of income. So for such type of income, we need to go by the agreement. What is the agreement saying? License fee for monthly rental and variable as a percentage of turnover. So, which means turnover has to be considered for which period? For the given financial period. So revenue will also be recognized for the same financial period. If the agreement says it is based on turnover for the period, for the same period we need to recognize the revenue. Right? So we need, here the rule is in the year in which the income arises, in the year in which the income is accrued, okay, we need to recognize the revenue. You can also use the word accrual. Right? Accrual is the right term that we can use it here. So let's see how the answer has to be framed. As9 on revenue recognition is concerned with the timing of recognition of revenue. The amount of revenue arising on a transaction is determined by the agreement between the two parties involved in the transaction. However, when uncertainties exist in the determination of the amount or its cost, these uncertainties may influence the timing of revenue recognition. This point is optional. Okay. In the present case, monthly rental towards license fee and variable license fee is the income related to the common financial year, which means to the same financial year. Recognizing fee as revenue cannot be deferred just because the invoice is raised in the next financial period. Okay. It should be recognized in the year of accrual. This word, if you write, your answer is you are hitting the nail on its head. Sanjay, your answer is, your question is, how can we predict the turnover without the audit? You can predict the turnover as on the end of the year, see, based on actuals. Okay, you need not certify it exactly, you can at least estimate it. Later, any changes in estimation can be raised in the subsequent year, but the entire fee cannot be deferred to the next year. That is the point here. Okay, so the contention is wrong. So here, what are the points that you need to relevantly note for the examination writing is, amount of revenue is based on the agreement. Okay. In the given case, monthly rental and variable license fee is for the same financial year. Therefore, it cannot be deferred because invoice is raised in the next financial year. Revenue has to be recognized in the year of accrual. So these highlighted points that I have given in bold will be your, basically these are the words that the examiner will look for from your answer key. If these words are present, then your answers are valid. Yes? Okay, so question number 7A is clear. Moving on to 7B. Indicate in each case whether the revenue can be recognized and when will it be recognized. Trade discount and volume rebate received. Bulk rebates and trade discounts. First of all, does trade discount and bulk rebates enter into the books of accounts? In other words, when you enter the, will you recognize the discount separately? No, it is already reduced in the cost of purchases, which means at the time of purchase itself, you are recognizing that revenue. Okay, so that is how you need to present the answer. Trade discount and volume rebates are not encompassed within the definition of revenue because they are already included in the cost. They represent a reduction of the cost. Right? Next. When goods are sold to distributors or others for resale. When I'm selling the goods for resale, which means I have some product which has come back to me, I'm selling it again. What is the rule for sale of goods? Sale or resale doesn't matter. Significant risk and rewards need to be transferred. So let's see the answer. When the goods are sold to the distributor or others, revenue can be recognized if significant risks and rewards of ownership have been passed. However, in some situations, the buyer may in substance be an agent. In that case, it should be treated as consignment sale. This is just an added point for your reference, but the first part is your answer. When significant risk and rewards have been transferred.
To the reseller.
Yeah, to the reseller. Next. When the seller concurrently agrees to repurchase the goods at a later date. So today he says that you give it to me, or in other words, today the seller says that I will sell it to you and I will take it back from you after 1 month. I will purchase it from you at this cost after 1 month. So he sells and later agrees to take back at a later date.
Not if the risk and reward gets transferred.
Does the risk and reward get transferred? It is a sale and repurchase, so the risk and reward does not get transferred. So effectively, it does not come under the purview of sale at all. Okay, it does not get covered under AS9. Right? For such transactions, when the seller concurrently agrees to repurchase at a later date, they are in substance a financing agreement or a leasing agreement. A sale and repurchase will generally amount to a leasing agreement or financing agreement. Okay? The resulting cash flow is not to be recognized as revenue as per AS9. If you want to find out what is the actual revenue, we will go as per AS19. Okay, but we are not worried about AS9 here. Right? Okay. Insurance agency commission for rendering services. Commission. Accrual basis. Based on the terms of agreement. But here, they have not given commission as a plain question. They have given insurance commission. So what is the accrual basis for insurance? That is what we need to answer. When will the insurance agency receive commission? When they sell the policy. If you sell one policy, you receive commission against that policy. So, insurance agency commission should be recognized on the date of commencement or renewal of the policy, which means once you have received the premium or once the policy period has commenced. Okay? Or you can simply also write it as insurance agency commission should be recognized based on completion of insurance policies or completion of sale of insurance policies. Okay, even that you can write, but this is more a specific answer. Your general answer is commission should be recognized based on the terms of the agreement. Accrual basis based on the terms of agreement. But here the question is specific. It is asking about insurance agency. So you should also give a specific answer. Right? So this is your answer for question number 7B. Any doubts? Yes, sir. Okay. Question number 8. Shall we? Okay. Given the following information of Rainbow Limited. On 15th November, goods worth 5 lakhs were sold on approval basis. Period of approval was 4 months, after which they were considered as sold. Buyer sent approval for 75% of the goods up to 31st January and no approval or disapproval for remaining goods. So for goods sent on approval basis, if the approval is not received within the time period, which is within the period of approval, is it considered as sale or rejection? It is considered as sale automatically. It is deemed as sales. So your answer for the first question is, in the given case, for the 75% of the goods, which is 5 lakhs into 75%, 3 lakhs, right? Leah? No. 3,75,000. 3,75,000 will be considered as sale as on 31st January or on or before 31st January. No approval received for remaining. Since the time limit for the approval has lapsed, then the same shall be considered as sold. Therefore, revenue shall be recognized for the remaining goods also. Split and write the answer. Approved goods, write the answer separately. Goods pending approval, write the answer separately. So let's check the answers. As per As9, in case of goods sold on approval basis, revenue should not be recognized until the goods have been accepted by the buyer or buyer has done an act adopting the transaction, or the time period for rejection has elapsed where no time has been fixed, reasonable time has lapsed. Therefore, revenue has to be recognized for total sales 5 lakhs. Okay, but I would recommend, this is how your answers have been framed in your by ICAI, but I would also recommend you to split the answer and show. For 3,75,000 on or before 31st January. For the remaining 125 before 31st of March. Next. On 31st March, goods were sold to Bright Limited, but due to refurnishing of their showroom underway, the request was delivered on 10th April. So goods were sold as on 31st of March. So sale of goods, what is the rule? The significant risks and rewards of ownership have been transferred. Therefore, the revenue needs to be recognized irrespective of possession. Okay. So point number 2, sale is complete but the delivery is postponed. So therefore, the entity should recognize the entire sale since significant, yes, rewards have been transferred. Never miss a chance to include keywords. Okay. Third, Rainbow Limited supplied goods worth 6 lakhs to Shyam Limited and concurrently agrees to repurchase the same. Repurchase agreement amounts to a financing agreement and hence does not come under the purview of As9. Okay. So sale and repurchase agreements where the seller concurrently agrees to repurchase the goods at a later date. Such transactions are in substance a financing agreement and hence the cash flow shall not be recognized as revenue in the given case as per As9, because the question is as per As9 only. Next. Due Limited used certain limited assets of Rainbow Limited. Rainbow Limited received 7.5 lakhs and 12 lakhs as interest and royalties. So 7.5 is interest, 12 is royalty. For interest, it should be accrued on time basis. For royalties, it should be taken on accrual basis based on the terms of the agreement. So your answer, revenue arising from the use by others of enterprise resources yielding in interest and royalty should be recognized when no significant uncertainty as to measurability exists. Interest should be recognized on time proportion basis. Royalty should be recognized on accrual basis in terms of the agreement. Fifth, on December 25th, goods of 4 lakhs were sent on consignment basis, of which 40% of the goods unsold are lying with the consignee. The consignee acts as an agent to the seller. Therefore, the risk and rewards are not effectively transferred. That is the point you need to convey. 40% of the goods unsold with the consignee should be treated as closing inventory. Sales should not be recognized. In case of consignment sale, revenue should not be recognized until the goods are sold to a third party where significant risk and rewards and property in the goods has been transferred. You can also write the statement that the consignee acts as an agent to the consignor and hence it is not treated as a transfer. You can also write that. That is an optional statement, added value. Okay. So this summarizes your question number 8 and summarizes AS9. Simple standard. Okay. And a lot of questioning possibilities. So till now we have completed 4 accounting standards, 4, 5, 7 and 9. Right? So is there any consignment of SANS? No, SANS records consignment is not there. Consignment can never be. So in a principal agent relationship, it cannot be like that. Del credar is only bearing the risk of bad debts and not risk of unsold goods. Okay, it is, you are not undertaking to take the unsold goods. You are only saying I will sell. If bad debts is there, I will bear the loss. Not necessary. Significant risk will be evaluated based on what kind of, to what extent your del credar commission is applicable. Okay. Right. So this summarizes AS9 and you can take your break for lunch. We will resume after lunch. So 1 hour from now, right? 2 o'clock. 2 o'clock sharp we resume and we will continue. We will start with AS19 and then go to AS17. AS19 is again a very important standard to be covered. We'll complete that and then go to AS17. Take your break. The earlier you are back, the earlier we will leave for the day. Okay?